I see people are dialing in. It's Barry Habib. I hope you're doing great. We see so many people still joining. So I just want to give it another 30 seconds or so and we'll get everybody on. In the meanwhile, I'm going to show my screen here. So hopefully you could see that. And in addition to that, what I'm going to do is I'm going to bring up the question window. So in the GoToWebinar panel, there's a question box there in the panel. And if you are so inclined for any comments, for any questions, I will try my best to monitor this as we go along and go through these questions and kind of just see if what we could do to help out. Oh, Michelle, I love you too. Thank you. You guys are so nice. I really appreciate you guys. Hey, everyone. Hey, everyone. All these nice comments. So first, let me just say for a moment here, the AIM team, Anthony, and your team is just so wonderful. And everything that you guys are doing for this industry is just amazing. So hey guys, you know what I'm gonna do? I'm gonna scare you a minute and bring my camera up here, all right? So you could see me. I hope everybody's doing well. So, but listen, before we start, I just want to hope you're doing great. You know, I hope you're healthy and I hope you're safe and I hope your families are safe. And this is really a crazy time, isn't it? It's like kind of a scary, shitty situation that we're in here. Let's just pray to God that, you know, we can be healthy and we can get through this okay. So I just want to tell you that, pray for you all, and I wish you good and health and that we just can get past this awful time. With regards to what's going on in the marketplace, I know it's hard. I originated loans for a long time as a broker, just like you. So I completely empathize with what you're going through right now. You're looking at your rate sheet and you're saying, goodness gracious, what's going on here? And to compound it, of course, the Fed cuts rates a few days ago, right? 5 days ago, the Fed says, okay, we're cutting rates to 0. We're going to cut by 1%. And now what does your customer say? Oh, I want 0. You know, my rate must have gone down. So I can't imagine the stress that you're under to deal with a customer who's asking for that, to deal with the fact that loans and sources are having a difficult time. They're doing the best they can. The sources that you do business with are so great, all of them, you know, they're doing the best they can too. And so I ask you to just have a little patience through this time. It's hard, and just keep things in perspective. Okay, there's still so many good things we have, and you know what? All these problems that we have, I mean, you know what? Thank God we have these problems, because there's so many people that don't have any work to go to. They're in a position where they don't have the ability to make any income coming in, and so although it's trying, we're going to get through this okay, and thank God that we have the problems we do. So let's address what's going on in the marketplace. I don't mean to be cold-hearted about it and talk about business here, because the human side of it's much more important, but listen, it's important that we go through this. And by the way, if you haven't gotten a chance to, it's right on my Facebook or on MBS Highways public Facebook. You don't have to be a member. We just want to put it out there for everybody. I did a wonderful interview with Dr. Mike Roizen, who's the head of the Cleveland Clinic, and it was just amazing. So please, if you get a chance, take a listen to that. It's not all about business. It's mostly about health. You can pass it along to anybody, and hopefully it gives you information for you and your family to benefit from. So let's take a look at the market and let's see what's going on. So first of all, what we want to do is we want to see where we are today. We're down 22 basis points, and you know what? That's quite the improvement from where we were. We're 63 basis points better than where we were, but it has been a roller coaster ride of roller coaster rides, hasn't it been? I mean, take a look at the chart here. Now, what this chart is showing you, and I'm just going to try and get this to where we eliminate some of these things. This is daily moves each day. And you know, let's go back. Let's go back for a year, okay? And you can see some of the biggest moves that we had, some of the most craziest moves. Like, this is an enormous change intraday, right? Like, gigantic. This is an enormous down day. These are huge, 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 huge moves, but they're dwarfed by what you see here. So for example, these moves intraday, this yesterday was a 250 basis point move. So it's got to be very difficult for you guys to navigate this, everyone. It's got to be hard. But what we want to do is we want to explain to our customer what's going on. So there's three main points I want to cover with you right now, okay? So here we are. So let me ask you this, because I happen to see a few comments coming in saying that the video is not exactly right or that the sound's not exactly right. I just want to ask you guys, is there something I need to adjust, or perhaps it's just on one or two individuals' end? Am I okay to continue like this? I just want to know that. Okay, so, okay, great. Okay, just want to make sure we're good. Thank you, everyone. I hear you. So here's what I want to show you first. And this is a chart I'm going to share with all of you, okay? It's an MBS highway, but don't worry, you don't have to be a member. I just want to get it out there for you. I will make sure that I get this to you so you can use it. So this is the first thing we need to talk to our customer about. It says, please understand that the Fed funds rate and mortgage rates are two very different things, and they don't necessarily move in the same direction. So let's take a look, everyone. When you take a look here and you see the blue line, that is the Fed funds rate, and I'm going back 50 years. The red line is mortgage rates. So look, we've seen over 50 years, mortgage rates certainly have come down. Remember when they were, goodness gracious, 18%, right? So, you know, a little perspective here is that it could be a lot worse. So when we see this and we say, okay, what happens when the Fed makes moves? Now, sometimes mortgage rates go along with it, like when the Fed hiked rates here, mortgage rates went up. But here, the Fed hiked rates, mortgage rates went down. Here, the Fed hiked rates a lot, mortgage rates went down. And many times when the Fed cut rates dramatically, mortgage rates just drifted lower. Here, look at this enormous move during the dot-com bubble, mortgage rates barely moved. Here, rates went up significantly, about 15 years ago when rates made that big move up, mortgage rates stayed about the same. And now you see during the financial crisis, when the Fed tried to take action, the Fed cut rates like crazy, but mortgage rates, yeah, they came down, but not a lot. And then if you take a look over the last 10 years, the bulk of it, the Fed had rates at zero. Mortgage rates, sure, they drifted down, but not in a straight line at any time. And they had been in a position where they were far apart from the Fed funds rate. Now, what did the Fed do? The Fed funds rate rose here. And mortgage rates, actually, at the end of it, they started to come down. And here's the big move down by the Fed. And what we're seeing now, it's not captured here, is a big move up in yield in interest rates. So the first thing, team, that we want to make sure that we go over and that we understand is that the Fed funds rate is very different than mortgage rates. And let me just pull back my camera so I could talk to you here, team, because I want to make sure that we are together on this. So the Fed funds rate and mortgage rate, so please explain to your customers, show them that chart. They're two totally different things. When we understand that, then hopefully we get them off the fact that the rate's got to be zero right now. But there are a couple of other really important things that are happening in our economy today that have caused mortgage rates to rise. I'll give you the two big ones. There are other factors too, but I want to keep it simple so you can explain it to your customer. So factor number one, this is simply an issue of supply and demand. Now, we understand that people are hurting out there. We understand that industries like the airline industry is hurting, and people are turning to the government to say, hey, we need help. And there's talk of people getting a $1,000 or $1,200 check if their income's under $100,000 a year. Well, if that happens to be 200 million people, that's $250 billion. If we're talking also about industries, like the airline industry is thinking about getting $50 billion. So when you start stacking this up, you're now into the trillions of dollars. Maybe it's not quite 2 trillion, but it might be. If everybody gets $1,200, I mean, let's face it, how long would $1,200 last you? Heaven forbid if that were to happen, if income weren't coming in the door, right? It's great and it's nice and it's a lifeline, but it doesn't last very long. How long this all lasts depends a lot on this virus, right? So we don't know how long we're going to be shut down. We don't know how long businesses are going to be at these levels of, closure. And we don't know exactly how quickly they can get ramped up again. So $1,000 per individual is great, but it might not be enough, and they might have to do more. When we talk about now maybe a $2 trillion number or maybe a $3 trillion number, where does this come from? The Fed, the Treasury, the government, they don't have this money. So they have to issue treasuries. They got to borrow the money. They got to borrow the money from you. They've got to ask you to make some of your investments there in businesses and pension plans, and they've got to sell this. And the fact is just supply and demand. When you have too much supply coming on the market, now over time, if it gets absorbed, and it will, that's fine. But a shock of all this at one time, it's not able to easily be absorbed. And that's what the market's trying to price in right now. So that's one reason why rates are elevated. Here's another. And this one is a premium that's now being put into mortgage rates. Why? Because there's a fear that maybe people can't pay their mortgage. Here's the thing. Stephen Mnuchin, who was our Treasury Secretary, he threw out a number that caused this move up in mortgage rates. When he said, if we don't act now, he didn't mean to make the markets crazy. He was trying to emphasize a point, but the market started thinking about this and saying, whoa, wait a minute there. He said, if we don't act now, the unemployment rate, this is his words, could be 20%. Now, let's just understand what 20% is. During the Great Recession, 12 years ago, it was bad. It was scary, right? Well, unemployment rate hit 10%. This would be double that. During the Great Depression, it was between 20 and 25%. That's the Depression. And I know for many of us, all we know about the Depression is, seeing black and white photos of how bad it was and hearing stories. But this was an awful time that we certainly don't want to visit. So what does that mean about people making their mortgage payments? So now in any investment, what you always measure is risk and reward. And I think you understand this quite well. The higher the risk, the greater the reward there must be. I mean, think about it in a credit profile of a borrower. The worse their credit profile is, maybe you can get them done, but the rate's probably going to be higher, right? So now the industry is trying to price in, and it's so hard to do, is if there's a risk that borrowers are going to pay back mortgages, how do we effectively price that in? And that's why you're seeing this craziness in range of pricing, and you're seeing rates elevated. Some of you are looking at rate sheets today that are, 4.5, 4 3/4, and that's not indicative of truly where the market should be if things were normal at all. But because we just don't know, and then the market is trying to factor in risk, they're erring on the side of a higher yield. And in addition, the other aspect of this is just sheer volume levels, which I anticipate will eventually slow down significantly. I mean, we've got issues with even appraisers and title, and I don't have to tell you. You guys know more than I do, certainly, as to the other challenges there. But we do know that there's some slowdown coming, and I think that we will lose the volume premium relatively quickly. I think that we'll also, once we get our arms around this coronavirus. Now, in that interview yesterday with Cleveland Clinic's Mike Roizen, I think what you'll see out of that is that there is a little bit of optimism, but it's not going to happen quickly. Please watch it, because it's good to just get all the info yourself. And obviously, I'm not a physician, of course, but I will try and reiterate what he said. Is it looks as if sometime in April this virus peaks. Now, peak doesn't mean it gets better or it's all gone. Peak means it's going to get worse until that point. I mean, think of a curve, so we're kind of here on the curve. It's going to get here bad, right? And then maybe in April, it reaches this level and it starts to come down, which means maybe by the end of May, it kind of feels like it is today, right? I mean, that would be a normal curve. I hope it gets faster than that. I hope to God it does. So when we take a look at this type of a curve, we are wondering, 2 months from now, what does that do to the economy if we're essentially in no better shape than we are 2 months from now? Maybe there's hope. Maybe there's these other drugs, the hydrochloroquine and things like that are deemed to be effective. Or the other thing you should know about is called bovine colostrum. That's what Dr. Roizen talked about yesterday as to what to take kind of as a prophylactic measure. So these are things we could do to try and help ourselves. He also goes into, why it's dangerous and what you could do and what you should be doing. Heaven forbid if you contract this. So please listen to him, because there's things you should and shouldn't do, and the proper amount of precautionary measures you could take to help you. So when we look at the devastation that this is taking on our economy and that it might last 2 months, this puts our country in a situation that we haven't experienced before. So it's difficult to price in. So I know that personally you probably have questions saying, where do I think rates might be in 3 weeks, right? I mean, that's only natural for you to ask that. It's very hard to answer that question. It is. And I'm not the type of person that ever shies away from putting my neck out on the line and trying to forecast things. But I will tell you that it's hard without understanding what this virus is going to do to the economy. I think that right now is an opportunity in housing because housing is extra strong going into this, as evidenced by today's numbers, which came out for last month's existing home sales was off the chart strong. So this will come back and it will be probably what leads us out, and you'll be very busy with purchase volume. Refinance volume, it's there. It's there if you do debt consolidation. Right now, people need you more than ever to do debt consolidation because they got to lower their debts. They have equity in their home. Now, I know you've got other issues and problems. I mean, God forbid somebody loses their job, that creates other issues too. So I'm not saying this is easy, but I'm not trying to be insensitive to you. I know that. But what I am saying is that you're going to have so much opportunity in debt consolidation because people will need you more than ever to be their advisor and pay down their debts, maybe accelerate the payments on their mortgage, free up cash flow. And it doesn't really matter that much what the rate is if you take a look at it, because debt consolidation becomes such a powerful force that you could actually take somebody to a higher rate and benefit them. Now, longer term, will rates come down? Yes. The risk premium as things settle down will come back. And it's going to get worse because let me just give you one other economic data point. I should have. I'm trying to kind of get everything in here, so forgive me. The other data point is this. Initial jobless claims. So this measures how many people file for unemployment benefits the first time that they file for it. So when we look at initial jobless claims, 2 weeks ago was 210,000. That's a very low number. Last week, it jumped a lot, but still really low to 280,000. It's estimated that this week it could be 2 million. Now, just to put in perspective for you, the most ever in our country's history was 600,000. Even the Great Recession, 600,000 people filed for unemployment claims. And even if you go back, now there were less people, so 600,000 might have been a bigger number, relatively speaking, but still 2 million? We aren't equipped for that. And you just can't process that. And don't forget, people who would normally process that are less efficient because they're working from home, or you don't want to come into contact with people. So it makes it so hard to do these things. So we're going to be with people that are going to be unemployed and maybe not have access to unemployment benefits like they normally would see in relatively short order. I think this is going to strain a lot of things. People are going to get frustrated. People are going to get upset. And what the Fed's tried to do was make sure that the banking system is operational. So you might have heard a lot of things that the Fed has done operationally as to what they can do. So the Fed is trying their best to make sure that, God forbid, when people go to the bank, that the bank has money. Because we talked about this last time, but it was very quickly to review with you. The banking system works like this. When somebody like you deposit money in the bank, you're lending the bank money. They pay you interest. But what happens is that the bank doesn't keep all your money there. That's a liability for them. They're losing on that deal. They have to put that money to work. So the Federal Reserve Act says they got to keep 10% in, and the other 90% goes to work, which means they only have 10% of your money. And that's okay because most people don't just draw their money out all at once. But if people have to go to the bank and draw money out, banks won't have that liquidity, which is why the Fed is doing these things. And you hear the terms, let's understand it. It's called repos. So repos mean that in the repo market, if Bank A is short on funds, they can go to Bank B and borrow money in most cases. Say, lend me money for the short term. A lot of people want to take out their cash. Just help me out. That happens all the time. But now Bank B doesn't have the money. So what the Fed is saying is we're going to inject this liquidity. It's not quantitative easing. They're injecting liquidity that then winds up freeing up capital because they will buy assets from the bank. They're saying, hey, you got treasuries, we'll buy them. You got a commercial loan, we'll buy it and give you the cash so you can give cash to the customer. And I think this is a very important thing that they did. They also removed a silly requirement from Dodd-Frank. Dodd-Frank, as you know, probably has a lot of issues, right? But one of them was that according to the stress test, banks had to do this collateralized loan reserve requirement where they couldn't even, if they had the cash, they still couldn't lend another bank money because they had to keep more on reserve for the financial stress test. So the Fed abolished that, thank goodness, at least temporarily. So banks have more money that they can lend each other to help out. And then they did some QE too. So what's QE? You've all heard the term. Let's just please, we'll go slow so we understand it. When the Fed lowers rates, that's easing, okay? So they ease rates and now they take them to zero. So could they go negative? A lot of people ask me, are they going to go negative? I really don't think they want to do that because that almost destroys the banking system. If you look at Japan as a case study, we can see that it was very detrimental to them. So we prefer not to go negative from the Fed, but you can quantitatively ease, meaning the equivalent of easing by buying treasuries and buying mortgage-backed securities. Now they're buying a lot of them. They bought more than they've ever bought this week. They bought double. During the financial crisis, in 1 week, they bought $160 billion of treasuries and mortgages. This week, they bought over $300 billion, more than double that they ever did during the worst crisis. So the Fed is viewing this as a huge crisis right now. And still, yields are much higher. So imagine if the Fed didn't throw $300 billion of buying bonds, yields would be much worse. So I've given you a lot of information on the bond market. I want to give you some thoughts on the stock market, and then I will turn it over to you guys for questions. I'll look here on the questions. I see there could be quite a few of them. So forgive me, I'll put the reading glasses on and I'll try and go through them with you and try and answer your questions for you. But first, let me talk to you about the stock market because I'm sure that's weighing heavily on your mind or your customer's mind too. Now, I'm sorry to say that my target was hit yesterday and the day before. So you probably know this, but when the S&P, which peaked at 3,400, I did feel that it was pricey. I told you guys a while back, who's ever seen me speak, you know I was worried about it, and I felt that we were headed for a recession anyway, and I just did not feel good about it. I tried to give you some indicators and saying that stock markets often decline by 50% during recessions. Well, when the stock market hit 3,200, I made a pretty bold call, and I said 2,350, and everybody from people on Fox to everyone thought it was nuts. And I said if it breaks under 3,019, you could pull up the tape and said look out below. I'm sorry to say that 2,350 was hit yesterday and the day before, exactly what we had thought. Now a lot of people are asking me, okay, so where do you see the stock market? Is that the bottom? And I hope I'm wrong. I pray I'm wrong, but I think that there's more to the downside to go. My target on the S&P now is moved lower to 1810. I know it seems like a very far away number, but remember I've been telling you guys, please don't fall for the head fakes when you see these big upward moves. I learned this lesson a long time ago. Those are not signs of a bull market, they're signs of a bear market. And I think we have yet to see the effects of what this virus will do from an economic standpoint. I pray to God it doesn't do what it can, with the bad things that it could do. I pray to God that it doesn't do the things, health-wise. But I think that we have not seen these numbers come out. And sometimes, the shock of that will push stock prices lower. And I think that 1810 for right now would be in line with what many recessions do, is a 50% haircut from peak to trough. So 3,400 peak, 50% haircut, that's 1,700. So 1810 is kind of in that neighborhood. I'll show it to you right now on the chart so we can kind of see it. And then we'll talk a little bit about your questions as well. So I'm going to go to the chart of the S&P right now. And when we take a look at the chart of the S&P, you have to kind of give it some perspective. So I'm going to go to a longer time frame here so you could see this with me. And I want you to kind of get some perspective here as to what we're talking about. So, when the stock market started to come down here and reach 3,200, here's where I made the crazy call of 2,350. Why? Because that's right here. I felt awful every time I heard all of these people on CNBC talking about, oh, buy with both fists here. It'll never break the 200-day moving. Well, these are not the times to be telling people to throw caution to the wind. I heard so many people say, oh, this is nothing. More people die from the flu. What they forget is the flu kills 1 out of 1,000 people. This kills 1 out of 30 people. Okay, so we don't want to be part of this thing, and it's also something that doesn't have a vaccine, so it's going to spread. It's highly contagious. This is not something to be cavalier about. And when you see the drop we've seen in the stock market, if I zoom in on this here, there's a lot of green candles here, and I'll show you what that means here. Just to kind of take it back with you here. Look at these big green candles that are here, which means big update, big update, big update, big update, big update. And people kept on saying, oh, it's the bottom. Oh, it's party time. It's great. I can't tell you how many stockbrokers from big houses would call me and say, oh, Barry, I think you're wrong. I'm seeing all of somebody on Fox said they wanted to debate me on it. But like I said, most people don't understand this. They don't understand that these big up days are a sign of a bear market. And I pray that this 2350 target, which was right here, is the bottom. I am fearful that it's not. It is struggling to find a bottom here, but the next leg lower, in my opinion, is down to, I will show it to you. Here's 2350, and you can see, well, when this bottom kind of hit, 1810 team, that's here. That brings us back to February of 2016, about 4 years ago. And I think that there's a very good chance that we hit this. I pray that I'm wrong, and I hope it does not get there. I pray that we come up with something. Believe me, I do not want to be right. I want to be wrong. But I think that in being realistic, this is a realistic target. So we are full of questions that if you give me just a minute, I am going to try and address those. So Glenn, you are saying yes, maybe somewhere in the neighborhood of even lower than 1810, maybe the 1600. Let's pray not. 670, well, 670 would represent from the Great Recession. 666 was the low, so I could see where they're coming up with 670, Glenn, but I do not think we get there. And Chris, thank you for your kind words. And Alex, thank you as well. So yes, Stephen, I agree. Mortgage delinquencies are definitely a problem that could occur. So somebody is asking here, if MBS price goes up, then MBS yield goes down. If MBS prices do go up in price, then yield goes down. That's the relationship. So, to kind of take it together with you, team. So let's all understand this, because it's important that we do. This is a good question. So if you were to take, let's just say you're lending money and you're loaning out money, and let's say you're loaning it out at 3%. So you've got a yield of 3%. Well, if the open market all of a sudden goes to 4% and you're sitting with 3%, it's not worth as much, is it? So in order for you to evaluate it or sell it, a 3% rate that's locked in a 4% market, you'd have to sell it at a deep discount. So your price goes down. If it was a $100,000 loan, if rates went up to 4, 5, 6%, let's say they go up to 6%, a $100,000 loan that's tethered to 3, if rates go to 6 and you want to sell that thing, well, here's how you do the math. And it's an oversimplification, okay? I'm just trying to give you conceptual. So in this oversimplification, if it was an interest-only loan, 3% on $100,000, you're getting $3,000 a year. But if you're locked into that as the investor holding that paper, and in the open market it's 6%, in order for somebody to buy it, they'd say, okay, you're getting $3,000 a year, right? In a 6% market, how much money would I have to invest to make $3,000 a year? I'd only have to invest $50,000. In this oversimplification, that $100,000 loan that you're holding is now worth $50,000 if rates go up. So yes, if yield goes up, the price comes down from 100,000 to 50,000. If yield comes down, the price goes up. So that's the relationship that we have. And it's a good thing that you bring that up, because it's important that we all understand this together. So Atul, that was a very good question to ask. If you compare the US to Italy or China in the virus curve, what do you think? Well, interestingly enough, this was kind of addressed yesterday. And this is why Dr. Roizen said probably about April would be the peak. May would feel like it is today. And then God willing, it gets better. And if we say MBS yields goes down, that should reduce rates in theory? No. If MBS yield and rate is the same thing. So just so you know, so if MBS pricing, what you see here, let's take a look together. So when you see price go down, remember, we're discussing price here, 101.3. So as we lose price here, the effective yield is going up, okay? So let's understand that. What is my expectation? So people are saying that the video is good, and some people are saying that the video is lagging a little bit. So I think that might be more of an individual circumstance, but we're gonna do the very best we can. What's my expectation on inflation with repo purchases and the drop in the Fed funds rate and stimulus? So you know what, I got to commend you, because Matt, this is an excellent question. And as a matter of fact, you may know the name Peter Bookvar. So Peter and I are dear friends, and you see him all the time on CNBC. We refer to him because he's a very, very, very bright guy. And he called me about the same thing yesterday. He says, Barry, he says, what do you think? You think the bond market's going to blow up, his words, because of all of this excess of paper that's coming on the market and all this QE, will that blow up the bond market? And I was like, Peter, I don't think it blows up the bond market. It clearly presents some issues and some problems, but I think there are other fundamental things there that will keep inflation low. I do not see inflation getting out of hand. Now, listen, who knows for sure, right? I don't know for sure. I'm only voicing my opinion. And one of the smartest guys out there, Peter Bookvar, he is saying that he kind of agrees with you, Matt, that it could potentially cause an inflationary circumstance. What I am saying is the same thing like people like Lacey Hunt are saying, that we don't necessarily see that right now. So that's our best opinion, but please understand that does not mean that we are going to be 100% right? So do we communicate all of this without setting additional panic? So Mark, this is a really good question. I think you have to tell people and communicate it. And if you do it in a way that explains to people that there's light at the end of the tunnel, I think that's a good thing to do. I think you have to kind of do it this way, where you get word out on social media, where you break it down and explain it. Here's why rates went up, these three things we talked about. And then we see things getting better because there are premiums that are currently priced in that will start to come out and rates will begin to come down. So I don't think it's necessarily adding more panic. I think it's important to just to speak it from the heart, but show that there's hope. So this is an excellent question. California is used to about 2,000 unemployment a day as of yesterday. The government said they're getting 80,000. You're correct. This is exactly speaking to what we had talked about. And Mike, that was from Alex. And Mike is helping us out here by giving the good numbers for us. You know, the population in the U.S. was 125 million during the Great Depression. Today it's 330 million. So we could see it. Now, yesterday, Darren, you're talking about Bill Ackman's interview. Well, Bill Ackman called it hell. You know, Bill Ackman, sometimes he's right, sometimes he's wrong, sometimes he's a little animated. So he was quite passionate yesterday. And listen, let's pray that it doesn't get as bad as that. The Fed increased purchases to 32 billion today. This is from Bill. And that came in and went in a flash. How badly does that mean that lenders need additional liquidity? Okay, so Bill, let's clarify. Okay, so Bill, you're right. It did come in a flash. So it's an excellent observation. But this isn't lenders' liquidity. This is just what's in the open market that is having a difficult time being priced now because of risk premium, because of increasing unemployment, and maybe people can't pay their mortgage. So what's happening here is in the secondary market, mortgage-backed securities trade every day. So we do a mortgage, we're done, we close that deal, it goes into a mortgage bond. But once we go into a mortgage bond, then it's trading on the open market. So today, if you bought Apple stock, right, and you made your trade today, but once you bought that stock and you've done it, it's trading in the open market, you know, next week, next month, next year, forever. Mortgage bonds are doing the same thing. So they're trading, and in that trading in the open market, the price of them is dropping precipitously because of this additional risk. Is how healthy are these mortgage bonds now? What happens if people stop paying their mortgage? That is causing the value of them to drop. Less people want to buy them, more people trying to offload them, causes the price to get worse. The Fed stepping in, and they did 32 billion in one day of buying mortgage bonds. That's a big number for them to purchase of mortgage-backed securities to kind of sop up the excess supply and stabilize the market. It's just that right now you have more fear, more people selling them than you do that's out there. So hopefully that helped with that question. Do I think that this has to do with the fact that investors are anticipating lower rates in the future, so they're charging a premium right now to hedge against early payoffs? It's a well thought out question. I don't think that that's happening right now. I think that early payoffs are going to be contemplated more in the future, where they might extend the early payoff period. But I don't think that's being priced in right now, because that is certainly a concern. You're right, but it's more of a concern that's kind of like phase two. Let's get through crisis. And then I think you're very smart in that you're thinking ahead. And what I think you'll see, Chris, is that we will have to be dealing with longer periods for early payoff. How can there be such a big spread between lenders on rates? Some lenders are still in the 3s or 4s, or others are in the 5s. Um, this is a very good question, Mindy. Very good question. So different lenders will have purchased different forward commitments. So if you purchased a big forward commitment and you're trying to fill that, well, then you could still be at where you purchased it. But if you've got a big rush and everybody's in there and locked in, then you're out of your forward commitment and now you're going to the open market, which would be much higher. So it's a very good question. And I know for all of you, this has to be frustrating, but I will tell you this, the forward commitments will get full. It's just a matter of time before we are all seeing similar rates. It's just a disjointed market right now. So in a little bit of time, it'll all come together, I promise you. Have you ever seen this kind of compression in premium spreads between coupon are non-existent? So Robert, forgive me, Robert, this is a really smart observation. Yeah, and I looked at this very closely. I was on a phone call with a lot of people from secondary markets at different large companies, and we were looking at this together because they had never seen it. So yes, you're right, I have not seen this, where if you go back 3 years or 4 years ago, you could see on on back end sheets 107, 108, 109. Okay, today it is almost no buy-up. I actually saw where you go higher in rate and the price where it normally gets more, it actually got worse. So it's the fear now that has overtaken the marketplace from an early payoff standpoint. This should alleviate itself, but I don't think you'll see as high levels of premiums as we might have been accustomed to. Over time, it's been slowing down. Who knows? There might be a time in the future once this all shakes out where you might have to be in a market where it's normal to pay a point. I'm not 100% sure of that, but it wouldn't surprise me. Do we have a chart with 10-year and mortgage rates? Yes, we have all that available within MBS Highway. It's all there. I didn't have any that I printed today to share with you. I would have been happy to give it to you, but we have all that within MBS Highway. So what are mortgage companies that are owned by fund companies like Caliber going to look like? Cash, Hedge, Fund, Wipeout? Well, that's a very hard question to answer. There are so many great companies out there, and we need them all. We need all of them, all the companies you work with. They're it's a good thing if they're strong going into this. I think that they will be okay through this, but we've got to be patient with them, and we've got to try not to be critical of them because, listen, we need them, right? What good is it if you originated $10 million in a week if you got no place to put it, right? So please be patient with all these great companies. The wholesalers that you go to, UWM and Caliber and PRMG and everyone else that's out there that has been so good to us. We need to just be patient with them. We need to understand that the things they're doing are not in any way shaped to hurt you. They're not trying to make this into a party and say, "Ooh, goody, we make more money." They're just trying to make sure that they're there for you in the long run. So please be patient with them, and please be able to say, we trust in the things that you're doing are not there to take advantage of us or our customers. We trust that that'll make that partnership with you endure through difficult times so that we have many more good times together. Team, I'm going to look here. I see there's quite a few that came up here. But the stock market wouldn't have tanked without coronavirus? Mike, that's a good question. I thought the stock market was headed lower. I thought it was priced for perfection. And when you look at a 21 price to earnings ratio, Mike, we know that according to history, the next 10 years of returns are always compromised. So I was looking for the stock market to have a tough time through a recession anyway. I don't think it would have reached these levels, and certainly not the level that we've seen drop as quickly, but it was headed lower in my humble opinion. But listen, nobody knows 100% of the time, right? What am I doing with my investments? So Cassandra, as I've made public, I was probably a little bit early, but I did transfer out of the stock market and got into the bond market more a while back. Before I did not get out at the peak. I got out before that. But I felt that things were getting a little bit too rich for my blood, and maybe just because I've been around for a little bit, I've seen kind of movies that look like this, and when you see certain patterns emerge, But here's what I am preparing to do, Cassandra, and I'm preparing to try to come back into the market somewhere below 2,000 on the S&P. Now, maybe I'm wrong and maybe I miss it, okay? But I think somewhere below 2,000, and who knows, maybe I'm early. But I think below there, with a longer term time horizon, 4 or 5 years, I think those investments for me will do well. I cannot give anybody here financial advice. So you asked me a personal question. That's what I'm doing for myself. And then Mr. Engel or Miss Engel, forgive me if I'm getting that wrong. What's your opinion about those of us who are holding on to retirement accounts that are in play in the stock market? Don't want to catch a falling knife, but should I be selling? Oh, so this is Tammy. Hi, Tammy Engel. Now I know who you are. Hi. And Tammy, I think you're right that you don't want to maybe sell into this where we are right now. If you do think things are going to go lower, there are ways that you can protect yourself. You could maybe buy some puts on the market so that if it goes down further from this level, you've got some insurance. It's almost like you're a capital markets person and you're hedging, right? That's what they do in hedging. So you may want to buy some puts. It's kind of cheap insurance, so that might protect your investments from the drop we're about to see. And then maybe you could buy a little more when we hit there. Hey, Dan, this is just really nice of you to say. Thanks, man. I'm holding up great, buddy. I am. I'm a little tired because, I'm trying to do the best I can. And this is a tough time for everybody. Listen, I'm worried. I've got children. I worry just like you do. So I'm doing the best I can. And we just got to keep all of us. We just got to kind of just keep helping other people, because this is a time where other people need us, especially you guys. You guys are doing so much important work to help people that are struggling, that need you. They need you to help reduce their debts or help save them money or get them closed on their home. So you guys probably have it a lot harder than I do, but I'm just trying to do my part. Why are mortgage rates not going lower than the 10 years going down? I think we kind of addressed that a little bit, Jim. So I don't want to try and repeat that too much, but please just remember that the 10-year Treasury and mortgage bonds, they're in separate camps as well. They do have a relationship between the two of them, which over time kind of levels out. But the problem that mortgage-backed securities have today is this new problem that a consumer who takes out a mortgage may have a difficult time paying it, meaning that mortgage bonds have additional risk of now repayment. The Treasuries are backed by the full faith and credit of the U.S. government. So presumably that isn't an issue for them. And that's why you're seeing the disconnect. What about following the Shiller PE ratio? So Grant, that's also known as the CAPE ratio. It's the CAPE index. So that is something that for a while had shown the stock market to be overvalued. So I agree with you. That is something that is a very valuable indicator. Many people disregard it because they just thought the stock market would go forever. But you're very wise in looking at that, because Grant, that is showing to be something that was a canary in the coal mine. So when do I think mortgage rates will get close to where they were a couple of weeks ago? Again, guys, Jacob, it's a hard question to answer. Really it depends on how quickly we can recover from the coronavirus, how quickly we bring the rates of unemployment back to a more normal level. As businesses get back, people have more money. We will get this premium out. So the answer is good. We'll get there. How soon is, I just don't know the way that the trajectory of the virus is. So it's very hard for me to answer, but I think that's an answer that happens in months, not years, but not days. Okay, I think it's a few months. As a correspondent lender, do I see that any investor will not purchase a loan? We're stuck with loans on the warehouse line. Oh, Alex, I hope to God not. We are seeing the Fed do everything they can, and bailouts to industries. This is such a vital industry. Let's hope that we're one of those, not just the airline industry, because we provide, in my opinion, just as important a service for people. Do we see 2 3/4 by the summer, Jim? No, in my opinion, I do not think so, Jim. Unfortunately, I don't. Now, had we not have gone through this coronavirus, I believe we probably would have gotten to a level of around 3% or less, and we did touch around those levels, but it's not going to happen in the summer, in my humble opinion. How do I feel about when you told everyone rates were going down the first time you spoke out with Frank and Brian, said where rates are going down into the 2s? Well, I feel great about it because I was right. If you think about it, rates did touch into the 2s, and it was an exact correct call. So I feel great about that call. I feel badly that we had economic circumstances change all of that. When will I be emailing you the interview with the medical doctor? So, Ruthie, all you have to do is go to Facebook and go to MBS Highways Facebook page, public facing, don't have to be a member. You can go to my Facebook page, either one. So how is this different from 2008 compared to now as far as banks going out of business? Yeah, I see what's going on with some of the other lenders that you mentioned too on the non-QM space. So non-QM is kind of like the first line, right? Because let's think about this. The riskier the transaction, the more difficult the market's going to be on risk right now, because the presumption is that non-QM transactions tend to have higher ratios to begin with. So therefore, in financial stress, those loans will be less forgiving. So I believe that the market's just trying to respond to risk there. So let's hope that those lenders are okay, because we certainly think that they provide such a great part of our market. So I think that what we need to do is just wait and see what happens, and hopefully they'll be okay. But this is a difficult time. Same person saying, I lost half my pipeline for not locking. Well, if you would have listened to our advice here, because I want to show you here why you should listen to our advice here, is because here's what our advice has been, is that we said float all the way here. Our locking days were here, here, and here, and here. So if you would have listened to us, you would have done very, very well. But look, here's what they say: the best time to plant a tree was 20 years ago. The second best time is today. So hopefully you'll take a look at that. And thank you for some of the very, very, very nice comments that I'm seeing here. I appreciate that. Now, Lillian, you're saying, okay, you did not lock your clients. What do you say? Lillian, here's what you say. Here's what you say to yourself. First of all, it is not your fault, Lillian. You did not cause this situation. You didn't cause this virus. You didn't cause the financial markets. So forgive yourself first, okay? And all of you need to do that. All of you need to remember that this isn't your fault. You didn't do this. As far as your customer goes, we have to explain to our customer that, as frustrated and upset as they might be, and their fuses are going to be short anyway, because they've got all kinds of fears too. But when we look at this entire situation, there's no blame here. Okay, this is circumstances. And by the way, what if you locked in your pipeline and because of the inefficiencies or because of the market, you couldn't get the thing closed on time? Totally out of your control, out of the company's control. Appraisers can't go to home. I mean, these are unusual circumstances. A little bit of grace, a little bit of forgiveness. Sometimes this is just, the world is a perilous place, and we try for it to be fair and righteous all the time, but sometimes things happen. They're called acts of God. Okay, this is certainly not a godly act, but this is an act that occurred that's nobody's fault, Lillian. So do not be hard on yourself, and none of you be hard on yourself. Do you think the government will buy MBS? Do you see it having zero effect with traders taking a profit off that little jump? Traders aren't making a profit here, man. They're trying to make a living, certainly, but they're trying to use it as an opportunity maybe to get out of positions or create liquidity. The open market's the open market. There's always a buyer and a seller on a transaction. The buyer thinks that the price will go up. The seller thinks that the price will go down from that level. It's that simple. The government is buying MBS. It seems to be hopefully settling the market some. I could only imagine how bad it would be if it wasn't. But we are clearly still in a volatile time of uncertainty. And until certainty starts to show up, we're going to have to expect some moves. And in most cases, when there's uncertainty, the fear of the unknown results in more people wanting to avoid risk, because the risk is theoretically infinite, than willing to take on risk. Please remember that. Explain hedging costs and mortgage servicing values. Okay, here we go. So when you promise a rate to a customer and say you're locked in at 4% for a number, so it's not as if 4% magically gets locked in the universe. That's simply a promise from your company to close the loan at 4% to your customer. That's all that is. It's just a promise. And what happens is now, from the date of that lock until the date of the loan closing, your company has that loan as potentially seeing rates drop or rates rise. If rates drop, they would be making more money. If rates rise, they would be losing money. But they do not want to be in that game because it is too dangerous and too risky. So to avoid that, they do something called hedging. You've heard the term. And what a hedge means is that Your company essentially, if you've ever shorted a stock, what they're doing is they are shorting mortgage-backed securities in essence. What that means is that as mortgage-backed securities, if they were to, let's say, get worse, that means that the rate might have gone from 4%, let's say 4.5%. If it's 4.5% by the time they close, well, your company's promised 4%, so they're going to lose 2 points on that deal to pay it down to 4. But they shorted mortgage bonds. So by shorting mortgage bonds, now the value of that short goes up, giving them almost all the money that they need to cover that payment to bring the rate down, and they're good. But something really crazy happens the other way. If rates get better, well, then on paper, your mortgage company said, oh, I locked it at 3.5, I'm down to 3, I stand to make an extra 2 points. But they shorted it. They're losing money on that short. So it winds up being the same thing with one exception. And that exception is this. The broker-dealer is looking at the account and saying, wait a minute, in that short position, you're negative. And anytime you get negative by about $250,000, you get a phone call from the broker-dealer and they say, hey, write me a check. Now, the lender is saying, well, hold on a second, look at this on paper. I'm going to make all this money on this loan when it closes. Give me another 2 weeks. And the broker-dealer says, sorry, I don't know if you're going to close the loan, when you're going to close the loan, not my problem. You've reached the threshold, write me a check. And thank God all these companies that you're working with are strong enough to do that. But this is what happens with hedging. So this is why we have to have a little grace for these companies that we're working with, because they're losing money on servicing. They're expensive hedging costs, rate lock renegotiations, or if you pull a loan and go to another lender, this insurance that they're buying means that they've lost that money. And then this is all part of some of the things that they go to. We talked about non-QM. We talked about the bond market here. Let's just see here. I'm trying to, what are the pros and cons for buying a home at this moment? To the extent that you feel comfortable enough buying a home right now, I think you'll have an opportunity, quite frankly. I think in the short term, I think that home values probably have to take a hit, okay? So if you are going to go out there and buy a home now, you probably want to come in a little lower and maybe the seller will take it. So if you have that luxury, that you have time on your side and you could come in with a little lower bid, I think that there's a chance that you might be able to get a great deal. And then as we come out of this in a few months, the housing market will recover most quickly of everything, and you will see home values come back quite a bit as soon as employment starts to come back. So I think that you'd be in very good shape. So that's my opinion in the long run. So we talked about mortgage rates. We talked about, okay, here's REITs. So somebody's asking me about REITs. It's very interesting because the top housing analyst in the world, I just had a call with her and all of her sales team, Ivy Zellman. And Ivy has the same concern about REITs, but her feeling, my feeling is the same as I just expressed to you. Real estate will come back. It will recover relatively quickly once we get past the virus. Employment starts to come back. Real estate will be roaring back. So to the extent that there are depressed levels or values, I think they go down a little further in REITs if you're looking to invest in them. But there will be, in my opinion, from here, I think it's a good opportunity. But as they come down, it presents what I think is a very good buying opportunity. And Matt, thank you very much, my friend. And so many of you with so many nice things. And someone's mentioning Elliott Wave. And you know what, Patricia, when you talk about the Fibonacci level here, obviously you've got some technical expertise here. And I wouldn't presume, but you didn't say so, but I'm presuming you're talking about the stock market here. So let's go back to the stock market and let's show this over the long haul. When you see these waves, 1 wave, 2 waves, 3 waves, there's usually a 4th wave in something called the Elliott wave theory. Yes, those technical analytics oftentimes are very accurate, but we are dealing with something very unusual here by way of the virus. So that presents a different set of variables than just normal circumstances. And there are more questions that I can get to here. So let me try and go through this. Let me see, the potential for unemployment to skyrocket. Do you see real estate values in the next 3 to 12 months? Okay, we've kind of discussed that as well. Let me see, this was going to happen anyways. The magnitude is way more significant than ever imagined. You are correct, Tara. How will a Biden presidency affect mortgage rates, Jim? So I don't think the presidential election will have as great an impact because under either scenario, Democratic or Republican presidency, you'll probably see rates behave well over the long term because debt levels are probably going to cause the velocity of money to slow. And I think that this is something that you'll probably be in a lower rate environment for a relatively long time once we get over this crazy hump. If a person gets into a purchase contract today with 30 days to close, is it best to lock or float? Just worried about it won't get better in 30 days. So clearly, Veronica, this is a very good question. I know it's on your mind. I think that rates will stay elevated for the next 30 days. I think at this point in time, if there's an opportune day that you have to lock, today may be one of those days. I would say that perhaps this is a good time to consider locking because I think in the next 30 days, once this package comes out to try and help the economy, the magnitude of it might give bonds a reason to be scared. Do I think the stock market will shut down? I do not. So Tara, good question, but I don't think the stock market shuts down, although we will see social distancing in the stock market. When Broadway opens back up, let's have a private showing. Yes, Darren, I hope to God they do, because we are really, really hurting as far as Rock of Ages goes. On a personal level, for me, it hurts because, listen, I don't care about the money I'm losing on it. It is what it is, but I just feel bad because we have such wonderful people that are my friends and my teammates, and it just hurts my heart to see these wonderfully talented and gifted people hurting as well. So thanks for the kind wishes for Broadway, and God willing, if it does come back and if Rock of Ages is able to survive, you guys, you can come to the show on me anytime, man. Just say the word and I got you. And team, we are now at 2 p.m. and I want to be respectful of your time that you agreed to spend with me. I want to thank you guys very much. Let me bring back the camera here for where we were. And I do want to mention to you, because many of you have asked me about MBS Highway, and you guys have asked if you could get on MBS Highway, if there's a discount for AIM or anything like that. Let me just really quickly kind of put something up there for you, because there is a special deal with AIM. If you'd like to get on board, here it is. I'm not trying to give you guys a pitch. I'm just going to put this up there for you guys, and you could guys take a look at it. If not, one of the things we do that's really, really helpful right now in this time is it's called Social Studio. And Social Studio turns your computer into a teleprompter. And I just want to show you real quick one of the things you could be doing if you went on our site to Social Studio. One of the popular scripts right now is what you're all asking me. It's a Fed cut does not equal lower mortgage rates. So if you wanted to, you could take this script, you could use our tool, and you could say, okay, I want to use this. Now there's many, many scripts. Okay, there's all kinds of scripts that we have, pages and pages and pages that you could do, area specific for your marketplace, you know. But let's just say you wanted to say breaking news with this Fed rate cut. I got to get it on social media. Here's your script. You could edit this. You could say here, I'm Barry. I'm Barry. Contact me so I can review your situation. If I like that, I could save it. I can go to my phone and do this. I could go to my desktop and do it. And if I go to my desktop and do it, what you want to see here is you want to say, okay, so I'm on my desktop, and now it turns my desktop into a teleprompter. Now, if I get my camera in here, then what'll happen is here I am, and I'm ready to record. This is a 45-second script. So if I say, okay, what would it look like? This is what the font looks like. Maybe I can make it smaller, right? So I can make it small, or I can make it bigger, whatever I want to do. In addition to that, here's the font size, sorry. And here is the scroll speed. So I could speed it up if I want. I could slow it down if I want. I can make that font size big so I don't have to wear my reading glasses. And then I'm ready to go. So here we go, recorded, 3, 2, 1. You probably heard that the Federal Reserve, also known as the Fed, has cut interest rates to 0 on the Fed funds rate. There's a big difference between the Fed funds rate, which can change day to day, and mortgage rates that can stay in place for 30 years. Mortgage rates are normally based on mortgage-backed securities, which have done very well, bringing mortgage rates towards historically low levels. But recently, the turmoil in the financial markets has caused mortgage rates to rise, even though the Fed has cut its rate. I believe that there may be an even bigger opportunity to consolidate your debts, reduce years on your mortgage, and create wealth, all by keeping or reducing your current monthly payment. I'm Barry. Contact me so I can review your unique situation. Stop recording. It's 38 seconds. What can I do? I can review it. So I can see if it's good, and then I could download it. In one click, I could post it to social media. It's that easy, team. So that's one of the things that we certainly can do for you and help you with that Social Studio. And if anybody wanted to get on MBS Highway, you know, normally it's $199. We have a deal through AIM for exclusive for AIM members. You go to mbshighway.com/P for pricing, and brokers are better. There you go. If you wanted to get on board, that's the deal that we have at the discounted rate. So team, God bless you. Thank you. Keep safe, please, everyone. Just, you know, be careful out there and take care of yourself. Be good to each other. Be kind. You know, this is not a time to rock the boat. This is a time to help each other out. Be well. Love you all. God bless and stay healthy. Bye-bye. Nicole, do I have something at 2? Okay.
All right, I was just trying to find the selling slide. I'm sorry, Bobby's on the phone. I told him we were having some technical.
Okay, good. Okay, good.
I'm just trying to find the slide. You don't have it handy, do you, with the selling for October that Dan made with the subsidy?
I don't.
Okay, I will look.